Okay, so we're going to talk about, and I'm not recommending, this is just education, diversifying with stocks and bonds, what to look out for, what kind of conversation you should have with your planner or your fiduciary. Very important information. So according to Smart Asset, equities are the same as stocks, which are shares in a company. When a company offers equities, it's selling partial ownership in the company. If you own equities, the value of your holdings increases when the shares you own become worth more than what you paid for them. That's a really simple explanation of stocks. We talked a little bit about in previous videos where you may own too much of one particular stock based on market conditions. But when you sit down with your fiduciary or you sit down with your wealth planner, it's important that they understand your risk tolerance and understand exactly what flavor you're looking for, not for like a 30, 60-day time period, but for a 5, 10, 20-year time period. So let's get into what dividends look like. Sometimes corporations give a percentage of their earnings directly back to their shareholders. This is known as a dividend. These payments aren't guaranteed at all, by the way, but for the investors desiring cash flow, they could provide major benefits. As an investor, you may choose either to reinvest your dividends or take them as income. So let me just give you a quick story. They call it the greatest chart ever. This is not my opinion. I'm just giving you information that was given to us. If you look at the S&P chart since 1980, take it all the way to December 2021. The S&P, if you reinvested your dividends the whole way through and didn't take any money out, your average rate of return is about 12%. During that same time frame, in each year, the average decline is about 14%. So this is where it's important to understand, if you have a real game plan, not to get scared or to be able to stay on path. Now, at the end of it, 35 of the last 41 years, on December 31st, the S&P ended higher than it started in January. Why is that important to understand? Because I don't think anyone has kept every dollar in the S&P since 1980. I believe that because markets fluctuate, it creates a lot of fear. However, if you are proper with your fiduciary and they understand the importance of dividends or cash flow or what you're looking to do with your money, this could be powerful as part of the overall portfolio. So let's get into what equity risk looks like and is. People invest in equities because of their potential for high returns. However, if people lose confidence in a stock, the price could plummet, meaning if a lot of people are selling. In your investment portfolio, your equity exposure is another way of describing your exposure to the risk that you will lose money in the value of the stocks you own declines. Now, you lose money in anything you do if you sell. So selling means it's lost, losing means it could be down. It's important to understand these languages and understand that, hey, listen, just because there's let's call it a correction going on, but you have a proper plan with your fiduciary, that doesn't mean you have to sell anything. Even if you're down, stay the course if it sits and fits with what the plan is that you and your fiduciary worked out. So let's get into what a bond is, and NerdWallet gives us the definition. Bonds are a loan from you to a company or government. There's no equity involved, nor any shares to buy. Put simply, a company or government is in debt to you when you buy a bond, and it will pay you interest on the loan for a set period, after which it will pay you back the full amount you bought the bond for. So now, they'll tell you, and I'm not here to say if it is or if it isn't, but it's less risky than a stock. I'm not sure if that's the case. But when you're diversifying stocks, bonds within those asset classes and have an understanding of time frame and weighted measurements, once again, this is a fiduciary conversation, it's important to know what this looks like, what this feels like, and how to play in that space. Okay, so we're going to talk about bond risk. Now, while bonds are safer than stocks, bonds aren't completely risk-free. If the company goes bankrupt during the bond period, you'll stop receiving interest payments and you may not get back your full principal. These are typically called junk bonds, right? Which give a higher level of risk but better interest payments. So it's always important to understand, like anything else, whether it's real estate where you want to look at raw land or whether it's bonds and you look at junk bonds, it's important to understand the level of risk associated within an asset class. So when it comes to bond risks, the ones that are junk bonds are probably on the higher scale of risk. So the question is, what should I invest in, right? And once again, you may not be able to answer this on your own. It's important that you go through a line of questioning so you with your fiduciary understand your tolerance and your flavor. But when it comes to bonds, you want to think about safer fixed income, lower potential gains, right? You want to think in that space. When it comes to stocks, you want to think riskier, volatile, no cash flow, higher potential gains, right? When it comes to stocks, you may want to think of riskier, volatile, 1 and 2, no cash flow and higher potential gains. Riskier, volatile, no cash flow and higher potential gains. And then how does that blend look? What are the weighted measurements? What is your age? Do you understand sequence of returns, rate, risk? I'm hitting you with a lot, take notes. But if you could really get into this space and speak with your fiduciary, your accountant and trust officer, make sure everyone's aligned, I assure you in that space, you will feel really good about what's happening, no matter what's happening with you versus what's happening externally. So listen, it's really about responsibility, and whether it's with us or like 3 other people besides who you're currently working with, it's so important to get a financial assessment, because when you do that, you become aware of things that you may not have been aware of, and you begin to learn to ask the right question. In a financial assessment, really what's going to happen is somebody is going to take a look at your overall plan and see if it sits and fits with your core values. If you like this video so much, go ahead, click the link below. One of the members here at Epic will have that conversation with you, guide you in any direction you may want to go. And even if you want to bring your fiduciary in on a call to speak with some of the affiliate fiduciaries with Epic, they love to sit down and talk as well. Thank you so much for your time. We look forward to co-creating and love the fact that you check out our channel. We just got into stocks and bonds, right? And we just spoke a little bit about what to look out for, what questions to ask. Every day we're dropping new content. If you, in fact, thought this was a valuable video, go ahead, hit the like button, subscribe, and ring that bell. And stay tuned for the next video, because it's going to be even more powerful. Every day we're dropping new content.